All right, let's get right into it. You've seen the headlines, right? The charts are going absolutely nuts. And hey, maybe you've even thrown some of your own cash in. But what if I told you that this incredible run up, what if it's all just a giant trap designed to take every last cent? Well, today we're going to break down exactly why this banana bubble is probably going to ruin you.
It always starts out so simple, doesn't it? Like on day one, the asset is super cheap. A banana, it'll cost you just one leaf. Seems like a fair price. Heck, maybe even a bargain. You're getting in on the ground floor.
But then things get absolutely insane. We're talking just 1 month later, and the price has just skyrocketed. 50 leaves for one banana. I mean, think about that. The value just went 50x. Your portfolio is blowing up. And at this point, you're feeling pretty good about yourself, right? You're a genius. You got in early, you saw the trend before anyone else, and now you're getting rich. It feels like you've totally cracked the code. But have you really? Okay, here's the hard truth. In this situation, you're not an investor. No, you're what they call a bag-holding monkey. See, you're holding on to this thing not because of its real value, but just because you hope some other poor soul will buy it from you for more. And let me tell you, the floor is about to drop out from under your feet. So how in the world does this even happen? Well, this whole feeling, this euphoria, this absolute buying frenzy, it's nothing new. It is a textbook, well-documented phase of literally every financial bubble in history. And today, we're calling it the Great Banana Mania. Look, pretty much every bubble follows the exact same predictable script. It's crazy. First, you've got the discovery phase. That's when the early adopters, these so-called smart money, gets in. Then comes the mania phase, and that is exactly where we are right now. It's when everyone, and I mean your cousin, your barber, everyone, rushes in because of FOMO. And what comes next? It is always, and I mean always, followed by panic, the crash. It's inevitable. So what exactly is the mania phase? It's when an asset is being bought only because buyers believe someone else is going to pay more for it tomorrow. It has nothing to do with fundamentals, nothing to do with what a banana is actually worth. It is pure, unadulterated monkey see, monkey do logic. People are buying just because other people are buying, and everyone just assumes the price will only ever go up. And this feeling, it has a classic historical parallel. It feels like the Roaring '20s all over again, back when every monkey barber and voice actor had a banana portfolio, right before the entire world just collapsed. It's that old saying, when your barber starts giving you stock tips, it's probably time to sell. Widespread speculation among everyday folks has always been a flashing red light that the top is very, very near. All right, now let's talk about the real hidden danger here. The thing that takes a small market dip and turns it into complete and utter personal financial ruin. This is what we're calling the King Kong pump. It is the secret ingredient that amplifies your risk to, honestly, catastrophic levels. And that secret ingredient? It's leverage. Plain and simple, it's using borrowed money to invest. It's what some people might call a big brain move, for people who want to lose everything as fast as humanly possible, because it magnifies everything, your gains, and way, way more importantly, your catastrophic losses.
Okay, so here's how it works in our little bananaverse. Let's say you put down just 10 of your own leaves, but the monkey bank comes along and lends you another 90. All of a sudden, bam, you've got the buying power of 100 leaves. You are controlling this massive position with just a tiny bit of your own capital. Or so it seems.
Now, this is the part that gets everybody hooked. It's so seductive. If the price of bananas goes up by just 10%, your 100-leaf position is suddenly worth 110. So you pay back the bank its 90 leaves, and what are you left with? 20 leaves. You just doubled your money on a tiny little 10% move in the market. It feels like free money. It really does. But here comes the brutal, brutal reality. What if the price goes down by just 10%? Well, now your 100-leaf position is only worth 90. The bank wants its 90 leaves back, and guess what? That is everything you have. Your initial 10 leaves, poof, gone. A tiny little dip in the market has just wiped you out completely. And this is where it gets really scary. This is where one person's loss triggers a massive chain reaction, and your bad days suddenly becomes everybody's problem. This is how all that leverage unwinds in what we call the inevitable death loop. So,
Where does it start? Right here. The second prices start to wobble, the bank gets nervous. Remember, they are not your friend. They're a business. And they call your loan. They want their leaves back, and they want them right now. In the real world, this is called a margin call, and it is the trigger for the entire house of cards to come crashing down.
And that one call is what kicks off the death loop. See, the bank demands payment. That forces you to sell your bananas, right? You have to cover your debt. But this new wave of selling pushes the price down even further. And that drop? Well, that triggers margin calls for other monkeys who used leverage. So they have to sell, which drops the price again. You see it? It's a vicious, self-reinforcing downward spiral. Okay, I know that was all pretty dark. That was the bad news. But here's the good news. You do not have to be a victim in all of this. There are crystal clear warning signs that a bubble is forming. So in this next part, we're going to arm you with the tools you need to protect yourself. We're going to learn how to spot the red flags. Really, when you strip everything else away, it comes down to this one simple question. Is the value based on something real? You know, like actual utility or a company's profits? If so, that's probably a breakthrough. But is the value based purely on hype, on FOMO, and the hope that you can sell it to some greater fool tomorrow? Well, my friend, that's a bubble. And you know what? The warning signs are usually staring us right in the face. When you start seeing average monkeys with zero experience getting rich overnight, that's a huge red flag. When you hear that everyone and their brother is using borrowed money to invest, red flag. When people are buying assets they literally can't even explain. When anyone who criticizes it is called a fool who just doesn't get it. And oh boy, the big one. When you hear the words, this time, it's different. You need to run.
So, the big question is, how do we take all this and turn it into a strategy we can actually use? This is about survival, plain and simple. It's about making sure that when the music stops, you're not the one left cleaning up the mess. In our world, it's about making sure you don't get left holding the peel.
First off, don't fall for the new era lie. Every single bubble needs a great story, right? A gimmick that justifies these crazy, insane valuations. Back in the 90s, it was the internet. Today, it's all about AI. You have to be skeptical of the narrative. Just because a smart monkey AI can draw a few weird pictures for you doesn't mean the company behind it is worth trillions of leaves, especially if it's not actually making any real profit. And this brings us to probably the single most effective defense there is, diversification. It's the advice your grandpa probably gave you. Don't put all your eggs, or in this case, all your leaves, in one basket. Look, it's okay to have some bananas if you want, but you better have some coconuts, some apples, and some other stuff too. You have to spread out your risk so a crash in one single area doesn't completely wipe you out. And here's one last really crucial point I want you to remember. For the person who's leveraged to the hilt, the market doesn't even need to crash to ruin them. It just has to stop going up. It just needs to go sideways. Because the moment that forward momentum stops, the entire logic of borrowing money to chase those gains it falls apart. And that's when the death loop can kick in. So as you go out there and you look at your own investments, as you hear all the hype and you feel that little tug of FOMO, just ask yourself one simple question. When the music finally stops, will you be the monkey left holding the peel?